Lease accounting distinguishes between operating leases and finance leases, sometimes called capital leases under older standards, each with distinct accounting treatments. A finance lease is essentially a purchase of an asset financed by a lease. It transfers substantially all the risks and rewards of ownership to the lessee, even if legal title does not pass. Common indicators include ownership transfer at the end of the lease, a bargain purchase option, lease term covering most of the asset's economic life, or present value of lease payments approximating the asset's fair value. Under both IFRS 16 and ASC 842, lessees recognize a right-of-use asset and a lease liability on the balance sheet for finance leases. Over time, the lessee records depreciation on the asset and interest expense on the liability, resulting in higher expenses in the early years of the lease. An operating lease, on the other hand, does not transfer substantial risks and rewards of ownership. The leased asset is treated more like a rental. Under ASC 842, US GAAP, lessees also recognize a right-of-use asset and lease liability, but the expense is recorded as a single lease cost, generally on a straight-line basis over the lease term. Under IFRS 16, nearly all leases are treated similarly to finance leases, so the distinction mainly remains relevant under US GAAP for lessees. For lessors, the accounting treatment differs. Finance leases result in derecognition of the asset and recognition of a net investment in the lease, while operating leases keep the asset on the lessor's balance sheet and recognize rental income over the lease term. In summary, the main differences between operating and finance leases relate to the transfer of risks and rewards, the pattern of expense recognition, and the balance sheet presentation. Recent accounting standards have reduced the off-balance sheet treatment that once distinguished operating leases, increasing transparency for users of financial statements.